From Germany's already been priced in. So also watching the defence stocks, Anna.
Okay, so from apparel to advertising to the defence sector, plenty of companies and sectors in focus as we get ready for the start of Wednesday's trading session. Expecting a little bit of a retreat. We're waiting for the CPI data out of the US. We're waiting for key auctions in the Treasury market out of the US this week. And so all of that could be material for where we go on equities as well. Just getting the FTSE 100 opening up and opening just a fraction to the upside. But we are expecting a little bit of downside as we reassess, take stock of where we are on the global trade narrative. I've talked about China-US and how we made progress on some specifics there, shoring up the Geneva agenda, Tom, but not really any big progress or any big reset in that relationship, perhaps might be some people's conclusion. And then since then, we've had these headlines around Europe suggesting that Europe wants to push out the deadline for trade narrative, trade conversation, to beyond July the 9th. How that will go down with Washington, with the US administration, we'll have to wait and see. But does this mean we reset our time horizon when it comes to getting to the end game on tariffs? So as we deal with all of that, European markets may be surprising us slightly to the upside, certainly on the CAC 40 up around 0.2%, and the FTSE 100. The IBEX down by 0.3%. And of course, we've heard from Inditex today, and I did see some opening calls suggesting that could be a little bit weaker on the inline numbers that we got there, Tom, from that particular business. And that can be a business such scale that it can weigh on the whole sector.
And that is exactly what is happening. It's down right now, to your point, Anna, 6% Inditex as they come out with those earnings that miss estimates marginally, but it's the caution ahead, of course, for this company facing the tariff and supply chain challenges, the FX impact as well, given, of course, stronger dollar, stronger euro, I should say, weaker dollar, and the moves around the Mexican peso also in focus. So Inditex is one of the stocks on the move today to the downside. To your point on a more broader picture across these indexes, some modest gains coming through for the FTSE 100, 8,875 right now for the UK index, up 0.3%. We have Rachel Reeves, of course, on the spending review and the capital expenditures details coming out later today. Over in France, the CAC 40 is up 0.2%. The DAX in similar territory so far, adding 49 points. On the sector story, it's autos at the top of the list so far, up 0.7%. Basic resources also getting a bit of a lift, up 0.4. On the downside, retail, and we can again tie in the Inditex story to that. Retail as a sector down 2.3%. That's the biggest loser across your sector so far in the session, Anna.
Yeah, it does absolutely seem to be that Inditex move is weighing on that whole retail sector, isn't it? Because Inditex is down by over 6%, Zalando down by 2%, H&M down by 1.6%. So it is having an impact on the rest of the sector, and it is the standout negative sector. It's down by 2.3% as a whole because of the heavy weight that Inditex plays there, I suppose. There aren't that many sectors in negative territory, though. The balance of things perhaps skewed a little bit more positively than anticipated. Basic resources up around 0.5%. Banks up 0.4%. Chemicals, technology, a range of sectors moving a little bit higher, but we're pretty flat, though, overall on these European markets right now. Let's get to Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, who joins us to make sense of all of the inputs into our market conversation these days. Karen, thank you very much for joining us. Help us understand, give us your perspective on what we've heard overnight on trade then, because on the one hand, you can spin this as de-escalation, these talks still ongoing, constructive relationship, positive language being used by these two sides, which of course is really important. But on the negative side, this is just shoring up something we knew about from Geneva and no new progress was made.
I think that's right, and we're just releasing our mid-year this week, and the key theme of it is sometimes uncertainty and not having a conclusion can be worse than having an adverse outcome, because at least when you know what's going to happen, you know what the tariff is, with your trading partner, businesses can plan, they can do things. But actually this extension of timelines, not knowing exactly what the tariffs will be on different regions, that I think is the danger for the second half of the year, because what happens in uncertainty is companies, households move into I'll wait and see mode. And wait and see can be incredibly damaging for expansions, because companies stop investing and households stop buying clothes, as we've seen this morning. And so that, I think, as we now start to think about the data, we've been in the policy space, our head has been in the policy space, as we now start to think about how this is going to play through the economy, how much is it going to damage growth? But maybe, as we highlight, is the market once again being complacent about inflation?
Yeah, that's really interesting. I was reading a Bank of England piece yesterday talking about UK households holding cash, to your point about what people do while they're waiting for certainty. Tom was raising this point. When we saw this red headline earlier on today, Karen, about how Europe might try and push trade negotiations beyond July 9th, Tom was asking that question about, what does that do to investors and to corporates when they're thinking about their planning for the year ahead? They don't have that certainty. I suppose I'm then minded to ask, should we not let the perfect be the enemy of the, well, maybe not the good, but the decent when it comes to trade conversations? Is that where we get to?
I think that's exactly right. I think at least having some, clear time frame, what the products are in scope, what the kind of numbers, is going to be much better than just having this continual extension of deadlines. Because what we absolutely don't need for this expansion is companies to stop investing. We were just post-pandemic, just getting on that global, not just US, but global upswing in investment. It's what we all desperately need, productivity, investment. And this is just going to, I think, quash all that, which then plays into some of our big investment themes. One of the things we're concerned about is we know that the darling of the market have been these tech companies. Never before have we seen a CapEx downturn and tech earnings prove resilient, which does not fit with the valuation of some of those mega cap tech. So, how this uncertainty plays into not only the economic outlook, but some of the big positions that are out there is something I think the market's not quite ahead of.
Are earnings expectations looking a little rich then, given that backdrop?
It's very hard to square the circle of what tech earnings expectations are with the trajectory for the US economy slowing down, particularly a CapEx-focused slowdown. So if you're of the opinion, which we are, that this slowdown is going to cause companies to wait, to postpone their CapEx spending, unless they absolutely prioritize within that their AI spend, then yes, those expectations do look a little lofty.
What is your view right now on US recession risks? Are we through do we have a clear steer in terms of a US economy that is actually holding up a little better than maybe some would have expected, given the tariff impact?
I mean, I think the data at the moment have been so clouded by the front loading, everybody getting stuff done now because of problems that could happen with tariffs and pricing later on. So I don't think the data up until now give us a good steer. Our core expectation is it's a slowdown rather than a recession. I think what's really going to prove interesting and critical is the role of the labour market, because I suspect, the other policy, of course, that President Trump is doing is really trying to curb migration. I think that will create a sentiment of labour hoarding. Companies in the US won't move to firing as fast as they might normally do, and that sort of cushions the downturn. But that comes back to my point then about perhaps what the market's underestimating is the inflation risk.
Karen, let's pivot the conversation to the UK, because we're going to get a spending review here. And I know you've plenty of experience of talking to policymakers about what they need to be thinking about and investing in. What are the investment decisions that you'll welcome, and what are the pitfalls that the government needs to watch for when it's allocating this money?
I mean, prioritising investment and making clear that in all of the difficult decisions that's not going to be the first thing to be cut is really important. Our problem here in the UK is productivity. Productivity is the secret sauce that makes everybody happier. Retirees get their pensions, workers don't have higher taxes. We've got to get productivity going. And anything that can help with that, we need investment, and government investment should stimulate private investment. So I think a clear signal that will be prioritised will be very, very good. Other than that, though, Anna, we're on to the sort of perennial conversation about how we have an ageing population. That means yet more money for the NHS. squeeze on all other aspects of spending. I mean, honestly, it's like I feel like every year that, the daffodils come up in February, and then in autumn we're going to be discussing whether taxes will go up to pay for the fact our population's aging.
And so it doesn't sound as if you think this is much of a game changer, spending review?
No.
New administration, new government. I mean, I say new, it's been a year, but this is the first big spending review, isn't it?
Well, it shows us, it doesn't tell us much about the envelope, that was set in the budget, but it tells us the priorities of this government. But the priorities are dictated by the electorate, and the electorate, as I say, are aging. The voting population is largely of the older cohort. That is, therefore, will decide the government's priorities, which is the same as all governments that have come before. So it's really just going to reveal this familiar theme, which the nation really just doesn't want to engage in, which is that we have more people retiring and drawing on the state, fewer people entering the labour market and paying into the state, and therefore the numbers just don't add up. And that doesn't add up for Rachel Reeves. It's not going to add up for all of her successors.
Karen Ward wants us working till our 80s. That's the message I'm taking from this. Guys, wake up, 80s, into your 80s, in terms of trying to close that gap. Karen, look, you've mentioned inflation a couple of times, and we haven't taken the bait yet. You're really concerned about inflation. That's coming through in your conversation with us this morning. What is your preferred kind of inflation hedge at this point?
Yeah, I mean, maybe just the background on it is we have been here before. We've had a supply shock coupled with a fiscal boost. We're reducing the supply capacity of the economy whilst pumping fiscal policy. That happened in 2022. What was the outcome? Oh, gosh, inflation. What a surprise. What worked in 2022? So that's one of the big chapters in our outlook. Let's learn our lessons from 2022. What worked? Now, obviously, a lot of investors have been already attracted by gold, but that's looking pretty expensive. In our view, it's the real assets, those that genuinely provide you inflation protection, whether that's core infrastructure, timber, transport assets. Those are the ones that genuinely reliably work in inflation surprises and inflation shocks. So that's where our interest is. And that's the key point we're making in this outlook, is there are still recession risks, but there are inflation risks. Construct your portfolio such that you're going to be covered for recession, covered for inflation, and then turn all other news channels except Bloomberg off. Really got myself in trouble there. Because then you're covered.
Yes. Okay. Seems yeah, good, interesting advice. But on the inflation side of things, I hear what you're saying about being a little alert to the inflation risks. But we were having a conversation earlier about how much pass-through we're going to see, for example, in CPI today. Now, maybe it's all still to come, but one estimate that Valerie Titel was looking at said a fifth of the uptick in inflation today is going to come from tariffs. It's a fifth of a 0.1% increase in the rate of core inflation over in the United States. This doesn't sound like, political career-ending inflation, that level of inflation.
I don't think it's going to be the magnitude that we saw in 2022. No, absolutely. But I think it's going to take a little bit more time to feed through. But if you look at some of the more forward-looking indicators, whether it's the PMI business surveys of input and output prices, they're pushing up. But Anna, as I say, to me, it's remembering that what bailed the US out from an inflation problem last time was a massive surge in migration. They had no supply, inflation was pushing up, the labour market was tight, and then they had millions of migrants arrived to ease that pressure and call inflation out the system. That's gone. There are no migrants arriving in the US. So now we're in a very tight labour market. We're once again going to push some cost pressures onto households. And I think where the surprise will come, Anna, and probably not till later on in the year, is when those workers start to say, I'd like a bit more money again. And that's when we really start to worry about inflation.
OK, Karen, thank you very much. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Tom, let's have a quick look at some of the core six then. In Guy's absence, we'll still keep an eye on his six picked stocks. We've got a mixed picture, actually, coming through in a market that's pretty flat, so that shouldn't be a huge surprise. A bit of upside in some of the tech names, so ASML, for example, going a little bit higher. Schneider Electric moves higher this morning. We're seeing some of the more defensive sectors in retreat, so Novo Nordisk, Nestle, pharma and consumer goods, both of those a little weaker. I'm not sure we see a huge amount of pattern coming through in those. Let's just get to a red headline that we have across the Bloomberg terminal, shall we?
Regret from Elon Musk. He has posted on X, his social media platform, of course, and I'm quoting from this post, "I regret some of my posts about President Trump last week. They went too far," says Elon Musk. Of course, this was the story that dominated the breakdown in the relationship between the world's wealthiest man and the most powerful man last week, I should say. Now Musk sensing some regret.
Yeah.
In terms of that breakdown, it was, I mean, as dramatic as it could get in the moment, and it seems like both sides are walking back to some extent. Interesting, I was speaking to Kathy Wood of ARK Investment, a huge backer, of course, of Musk and everything he's doing across his businesses. Yesterday, she said, yes, this did go too far and that they needed to resolve this conflict. And she pointed out that SpaceX alone gets $22 billion of contracts from the federal government. And there's the vulnerability should this dispute go on. So Musk seems to have realized at least that part of the equation, saying he regrets some of his earlier comments and social media posts about the president.
Yeah, this started to get quite real quite quickly, didn't it, for Elon Musk? He came out fighting against the president, and then the president threatens to go back on some of the contracts that Musk has been rewarded. So we wonder which of these posts in particular he regrets, but we will leave that one there. So Elon Musk with his regrets this morning. Coming up on the programme, Inditex shares slump after it reported first quarter net sales that were lower than analyst estimates. More on the world's largest listed clothing retailer. That's coming up next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We are 17 minutes into your Wednesday session. European stocks are flat, essentially, after a similar picture yesterday. Let's see if there's a catalyst for these markets. US-China trade talks, of course, wrapping up after 2 days. We look ahead to inflation data out of the US later today, Anna.
Yeah, are we back to thinking about the data, or do the catalysts for the market still come from the White House and the trade narrative? Well, let's talk about some of the individual corporates that are on the move then this morning, Tom. We have Publicis from the advertising space, some headlines there for that business. Publicis has won a $1.7 billion ad portfolio for Mars. This is from WPP. So previously Mars was advertising with WPP. Now that goes to the French-listed Publicis. They'll be handling media, production, paid social media, influencer ads and the like. So that stock up by 0.6% as a result.
Defence stocks actually performing relatively well across the session today. You can see the gains coming through. For the likes of Hensoldt up, 6.5%. This is despite the fact that Deutsche Bank analysts have come out and said valuations are now looking a little stretched in the defence sector. We know, of course, this has been a key trade for many investors on the back of expectations around fiscal stimulus from Germany. And Deutsche Bank saying a lot of the expectations, a lot of that money that Friedrich Merz and the German government have promised has already been factored into the price action when it comes to defence stocks. Nonetheless, you're seeing some pretty decent gains in the session today.
Yeah, so we were asking, weren't we, whether the defence sector would have another negative day, and no, it seems to be the answer to that one. Yesterday we saw those stocks on the back foot. Also not on the back foot today is Bayer, the German business, and we see that share price is up by around 1.9% for this large pharmaceutical business. And we've seen some analyst changes here. So it's been raised to a buy by Kepler Cheuvreux, price target set at €33, which is a little above the 27.26 that it trades at right now. So we will keep an eye on that one as it responds a little to some of that broker move.
Okay, let's get to another corporate story, another stock on the move, and firmly to the downside. That is Inditex, the parent company, of course, of Zara. You can see the drop there. Wow, 5.3% after reporting operating profit and revenue in line, a little bit softer, in fact, than the estimates. Sales did pick up in the early weeks of the second quarter, but investors are clearly concerned going forward about the prospects for this business. Charlie Wells is here to break things down for us. Talk about the report, what it means for Inditex and the share price reaction.
Yeah, Tom, so I guess this morning what we're seeing is this report just wasn't good enough, right? Yeah. There just wasn't enough of an acceleration factor here to kind of help the share price. We're seeing, a significant downturn there. And, look, Inditex for a long time had been this sort of industry darling within fast fashion, right? They really kind of bolted out of the gate after the pandemic. Their share price had really been kind of significantly higher than a lot of the other peers out there. And this is just seeming like these trade war tensions that we're hearing about may also be eating into the demand of this consumer. And I mean, Inditex had been in this sort of unique position where they have this, integrated supply chain. They are less exposed to China than a number of their peers here. But really, it doesn't seem like this report is kind of helping to kind of, set off some of the concerns that we've been seeing. And even the summer sales figure for that current quarter, just not as high as the year before. So that is posting soft demand.
And how does the performance of Inditex then, how does it compare to the rest of the sector, Charlie?
Well, look, I think investors have been asking this question, not just about fast fashion, but about fashion more broadly. As these earnings reports have come in, what is the narrative? I think there have been a lot of kind of divergent stories here. And one that we're seeing, and this report really does kind of feed into this story, is this idea that the high end and the low end are struggling, but you're seeing this kind of success in the middle market. So the parent of, say, Michael Kors or Ralph Lauren really kind of benefiting here from that higher income consumer sort of trading down a bit. So looking for kind of, value, but at that lower price point.
In terms of how the company is positioned going forward, given some of the challenges around tariffs, supply chains, FX effects, this is something that was flagged in the analyst notes this morning, wasn't it, in terms of the currency effects? How are we thinking about what could be the headwinds or indeed the tailwinds for the business in the months ahead?
I think currency is really important to pay attention to here. So in that report, they talked about a 3% hit to earnings in the year ahead because of currency. And there was, that idea that having this integrated supply chain, very Europe-focused, is a benefit to this company. But at a time when the euro is strengthening, at a time when the U.S., where we're seeing that dollar weakness, when the U.S. is their second most important market, that is a headwind that they are signaling this morning.
Charlie, I'm looking at some of their top-selling items on the website right now. There's a Western shirt.
I take it.
Western shirt. You can do a Western shirt You've got a polka dot shirt as well, which is standard. Denim jeans. Shorts? Do we do denim shorts?
Nice.
With sandals? Is that
It's
allowed?
been a while, but I think those are back. And this is something that Zara does, right? They try to respond really quickly to a lot of these fashion trends, but also that can hurt them if some of the trends don't pick up.
So you're confessing to just basically being sitting around the desk just shopping this morning then, Thomas? That's what's
I
happening
may have
here.
taken this as an excuse to look at this
Filling the
Father's Day coming
basket.
up, isn't it? So you've got your wish
Spoil
list.
yourself.
Yeah. Charlie Wells, thank you very much indeed. On Zara, parent company Inditex, the stock is down in the session today.
OK, Blackstone is planning to invest as much as $500 billion in Europe over the next 10 years, another sign of the continent's growing appeal to investors during a period of geopolitical flux. Chief Executive Steve Schwarzman spoke to Francine Lacroix about the plans.
We started here with no one. We now have 650 people here in our office in London. We're building a very significant new headquarters in Berkeley Square. That's probably going to be the nicest office building that's been built really since the wonderful Bloomberg headquarters here in London. So that's worked out. We're in a lot of different business lines, and we have a very positive view of the future here in Europe. We think we're going to be able to invest $500 billion over the next decade in Europe. We see it as a major opportunity for us. They're starting to change their approach here, which we think could result in higher growth rates. So this has worked out amazingly well for us.
Where do you see the best opportunities in the UK and Europe? Is it certain sectors? Is it certain parts of the economy?
We see in real estate, there's always opportunity as you go through cycles. We've been looking on a global basis with very similar themes with artificial intelligence. I see that Jensen Huang was here meeting with the Prime Minister at a tech conference and was talking about how the UK needs to invest more in infrastructure. Blackstone is the world's largest developer of data centers, and we're also the world's largest owner of data centers. So it's been a really core business for us.
It's been a pretty subdued year overall for deal making. So how do you approach monetizations, for example, at a time of heightened demand for liquidity from investors?
Well, we're in a cycle now where the markets haven't been accommodative to IPOs, and strategic sales to other private equity firms are difficult because they're having difficulty raising money. Fortunately for us, we finished our money-raising cycle, so we've got lots of money at the firm for these things. We're in an unusual position. But I think we sort of look at these things and say we sell companies when we think it makes sense. We've actually sold a good deal, surprisingly. It's because we have some very good companies with very good results.
Now, Steve Schwarzman, of course, Blackstone's chief executive, speaking to Francine exclusively. Coming up on the programme, the US and China agree on a preliminary plan to ease trade tensions, shoring up that Geneva agenda. But markets are taking the outcome with a pinch of salt in their stride. US futures pointing a little bit lower this morning, down around 0.25%. We'll dig deeper into what this means specifically around rare earths, magnets, tech, jet engines, and more broadly for the trade narrative. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
This is the opening trade, 30 minutes into our European session then. And European stocks actually a little brighter than maybe we had anticipated. US futures still pointing a little bit lower, but we do have basic resource stocks, technology, consumer products and services, giving us sufficient amounts of positivity to move us higher this morning. Let's talk about the broader trade narrative, though, because we've had headlines from that overnight, deep into the night here, London time. The US and China have agreed to a preliminary plan to ease trade tensions, which now goes for approval to both of the nation's leaders. American negotiators say they expect issues concerning rare earths and magnets will be resolved.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
All sounds very friendly. For more, we're joined now by Bloomberg's Lizzie Burden with details. Lizzie, what details did we get then about these discussions?
Well, after 20 hours total of negotiations, Anna, you had the US Commerce Secretary Howard Lutnick and the US Trade Representative Jameson Greer emerging to cast this as a framework for implementing the Geneva Agreement, that 90-day tariff truce through which we're about a third of the way. And as you heard there, it's essentially China agreeing to send more rare earths to the US, and the US in exchange rolling back some of the export controls that it had introduced in retaliation. But the question now is, what if the relationship blows up again, as we've seen it do since Geneva? And it's not encouraging, perhaps, that Jameson Greer says there are no more meetings in the diary for now. I think what's really crucial, and I've said it before, I'll say it again, is just how important export controls have emerged as a front in this trade war. Tariff may be Donald Trump's favourite word, but Beijing has just showed how well export controls can give you leverage in modern trade warfare. And now you've got the US trying to rustle up deals with other countries, whether it be South Korea, India or Japan. But President Xi's on the phone as well. He's been talking to the newly elected South Korean leader too. And the bad news for Donald Trump this morning is our colleagues Alberto Nardelli and Jorge Valero report that the EU actually sees July 9th, that reciprocal tariff deadline, as the best case scenario for when they could reach a US-EU deal. So perhaps that vindicates some of the economists who've been criticising the ECB's scenarios, which sees 50% tariffs, not even in their most severe scenario, all of which to say, Anna and Tom, is the road ahead could be pretty rocky.
Yeah, and to your point, if tariffs are Trump's favourite words, maybe samarium or scandium are the favourite words of President Xi Jinping right now. Rare earths he's using as leverage. Bloomberg's Lizzie Burton, thank you very much indeed. Let's get more on this and bring in Charles Parton, Senior Associate Fellow at RUSI. Charles has spent 22 years of his 37-year diplomatic career working in or on China, Hong Kong and Taiwan. So Charles, drawing on that deep experience and your granular understanding of the CCP and the workings, of course, of the inner halls of Beijing, what is your assessment of where things stand between the US and China after these talks?
Well, I think I tend to agree with your correspondent, Lizzie Burden. There's a lot of possible potential trouble on the horizon. I mean, the media talks very much about a trade war or a tariff war, but I think that the Chinese certainly, and I suspect the Americans do, the Chinese talk about a science and technology war rather than as much as a trade war. And indeed, I think it's much broader than that. It's a fight between, if you like, between systems, political systems and economic systems and value systems as well. So whatever the the external propaganda says, the voice of the party, the Chinese Communist Party, talking abroad about win-win or a community of shared future for mankind, etc., etc. Underneath, when you see what they say to themselves, they look on this as a struggle. It's a very strong word against hostile powers, and that's America and any of the allies that line up on the American side. So both sides, quite rightly, I think, coming back from the brink because China has a very strong weapon in the rare earth exports, controls and bans, and it's shown its sword in that area. And the Americans can do quite severe damage to the Chinese economy in the short term through some of their semiconductor the technology, aircraft parts, ethane for plastics, etc., etc. So they've rode back from that, but I don't think it changes the underlying hostility between these two powers, where the Chinese see America, probably rightly, as trying to contain their rise and repress their rise, and the Americans, quite rightly, seeing the Chinese as threatening their position as the global big power.
Yeah, Charles, and I think there's real value in framing it in terms of that longer-term positioning between these two superpowers. But the here and now question around where China is feeling the pain, whether it's tariffs or those export controls that the US is putting on. Which of those is the issue that China wants to address most quickly? Which is the one that is of most concern? Is it the tariffs, or is it those export controls, whether on aircraft engines or on semiconductors?
Well, I think it's both. I mean, China is always very worried about the employment situation within China. It's not good at the moment, the economy, and unemployment is particularly high. And we've got a whole load, 12 million or so graduates graduating very shortly, who will also be on the job market. And if you don't have a very good social security system, which they don't, and you've got massive unemployment, then you've got a lot of very unhappy people. And since all good things come from the party, then also the flip side of that coin is all bad things will be blamed on the party, and so it'll be directed at the party. That's a great worry, because it is fundamentally quite a brittle regime, and worries about protests and the potential overthrow, are demonstrated by the vast amounts of money that they spend on control and repression systems. So, but in the longer term, yes, I think they are. That they understand too that whoever's going to be the more powerful country in the future will be the one whose science and technology is dominating, and particularly the industries that depend from those new sciences, and possibly more definitely, in terms of energy and who has the right energy supplies, including, of course, all the new energies, solar, wind, nuclear, etc.
Yes.
So, that the worries are both short-term and long-term.
Charles, do you have a sense of how we get to the next stage in the trade conversation? Because we've heard from members of the US administration that there aren't further talks planned, but we know that a deadline looms on, well, at the early part of August. And if we don't have any kind of conclusion of the trade relationship conversation before then one assumes you default to higher rates of tariffs. Do you have a sense of where the off-ramp is?
Well, if you look at what's happened over TikTok, for instance, which also had a 90-day deadline on it, that's been extended. There's no reason why I think it's August the 9th deadline cannot be extended for another 90 days, if possible. But I think, as you said right at the start of the program, President Trump quite likes tariffs, so I think it's very unlikely that they're going to disappear in entirety. They're now down to 30% against China. I suspect that sort of level will be maintained in the longer term. But I think, as I said, the underlying tensions between them mean that we will see flare-ups and reconciliations continuing, because that's the nature of the, to be frank, a Cold War, one has to say. It played out in a different way than the earlier Cold War, but nevertheless a Cold War.
Right. And the relationship is much wider than just the trade relationship, Charles. But if we did see tariffs of 30% sustained, if that's the future, how does that reset? It might reset the balance of trade, and how might it reset this relationship between the world's two largest economies?
Well, as I say, I don't think it's going to in a sense it will be reset, because that in a state of sort of muted hostility. I think the other question that's actually really quite interesting is whether what the pressures will be on Europe, because I think it's quite clear that both sides will want us preferably to choose sides, and certainly not to choose the other side. And that was made clear, for instance, by the Chinese when the UK made a trade deal, reached a trade agreement with the United States, and we received warnings about not getting too close to the United States. But then if you look at what, for instance, Scott Bessent has said, and people like Brendan Carr at the Federal Communications Commission, which is also very important, they said you better not cozy up to China. And I think people kind of miss also, there was a very interesting memo which went out of the White House on the 21st of February, it's America First investment policy. And there's a couple of little paragraphs in there which say, and by the way, allies, you're very welcome to invest in us, but not if you've got Chinese technology there, and not if you're cozying up to America's adversaries. So, yes, here in Europe, we're going to have, I think, to choose. And Europeans don't want that.
Presented with that choice. Charles, on this point, European leaders heading, of course, to China in the coming weeks. They will be in Beijing. You've played that advisory role to the EU as well in the past. How far can Europe push that relationship then on the trading front with China, given that pushback and those constraints from the US?
Well, like the United States, Europe has seen what happens when China takes out its rare earths export sword from its scabbard. And I think one can say that the Chinese deliberately showed the gleam of that sword in the last few weeks to Europe as well. And many companies in Europe have been clamoring, one might say, panicking perhaps, about the supply of rare earths where the license has been held up in Beijing. And Beijing, of course, will say, well, that was just because of the sort of general rise in demand and chaos and the need to go through the bureaucratic hoops. I don't think anyone should necessarily be fooled by that. It's definitely been a warning. Europe and the United States were in a weak position over rare earths. We were warned back in 2010 when China used rare earth export controls against Japan over a fishing dispute. And we've done nothing about it in the intervening 15 years. I think they're going to have to. And you might say that as Europe, raises its defence budgets from whatever they are to 2 to 3 and possibly higher percentage, well, maybe a good part of that budget will be spent on ensuring that we and our allies, the United States, have access to rare earths. So that would be money well spent under a budget heading, let alone under an economic security heading.
So you're saying that Europe will need to choose, Charles, and that might seem like a straightforward choice between an ally and a country that isn't an ally, traditionally speaking. But as you set out, there are economic implications. Can Europe scale up access to alternative rare earths quickly enough to enable it to make that choice?
It's going to, of course, it's not an easy and clear choice at all. There are going to be great pains in this inflicted by both sides of America and China if they're not happy with Europe. And of course, when we say Europe, well who are we talking about? There's the UK, of course, and we're now outside it. But within Europe, there isn't a united position either, because if you look at countries like Hungary and Spain in particular, they are certainly taking different positions from some of the other major countries. And even within Europe, when one talks about countries, perhaps one should also talk about industries and big companies, because these days they also have immense powers, not least to influence the government.
Charles, thank you very much. We appreciate your time. Charles Parton, Senior Associate Fellow at RUSI. Coming up on the programme, the UK Chancellor Rachel Reeves will defend her fiscal choices when she sets out her spending plans today. We'll speak to the UK Treasury Select Committee Chair, Meg Hillier. That's next. This is Bloomberg.
Number of games overseas in recent years, and in fact you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television, you need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade, Wednesday, the 11th of June, and we have modest gains across some of these European equity markets, but overall, we move nowhere. To the downside, the Spanish market providing that. The IBEX down by 0.8%, so the Stock 600 overall is flat, despite the green on the screen that you see there. So the IBEX story, the Inditex story, is the negative one. Elsewhere, a little bit of positivity, perhaps. But US futures point downwards. Tom, let's just go through what we have ahead on the trading day. We've got the UK spending review coming up. US CPI, of course, a US Treasury auction, and the US federal budget balance, all that very much in the mix. Let's get to Valerie.
Karen Ward as well, Valerie, of JP Morgan, warning about the inflation risks and really trying to draw a line under it and saying, look, the markets are underestimating the inflation risks because of a number of factors. She talked about the immigration crackdown in the US as part of that, which, of course, ties into the protests in Los Angeles. What are you looking at when it comes to the inflation data? How far underneath the hood do we need to be looking to get a clear gauge?
Oh, look, I think there's going to be a lot of nuance in today's print because it's not just what the headline numbers are going to be, but it's parsing through those components that maybe led to a hot or cool CPI print and if they were related to a tariff-induced factors. So I think there is going to be a lot of head-scratching, a lot of analysis done on today's print. The worry for the markets is that the tariff-induced inflation shows up sooner rather than later, and we get hints of it in today's print. Most economists think that the bulk of this tariff shock might not come until later in the summer. Some economists pointing to July, we could get a 0.5 reading on core CPI month on month. But today, the estimate is for a 0.3%. And if you look at how inflation has been doing, if you look at the last 3 months and annualize it, we're still doing pretty well. It's 1.5% is the 3-month annualized CPI. So decently below the Fed's 2% target. It's just a matter of whether tariffs are going to disrupt this current progress on inflation.
Yeah, which makes me ask, because we just don't have any clarity on the tariff story, either in the short, well, a bit in the short term, but not really beyond July, then beyond August. There are key dates there. These things could drag on, though, as we know. And so you wonder how much the data can matter in that context, the very short-term inflation picture.
Yeah, exactly. Even the recent line that the EU negotiations are expected to go beyond the July 9th tariff deadline does really extend, perhaps for economists, just when this inflation shock would hit the U.S. economy. Currently, the thinking is later in the summer, but definitely that could push into Q4 if these trade discussions, these tariff negotiations don't necessarily come to fruition, and we have to keep waiting for the outcome.
Okay, Valerie, thank you very much. Bloomberg's Valerie Seisel with a look ahead to the U.S. CPI print. We're also looking ahead to the U.K. spending decisions. The U.K. Chancellor Rachel Reeves is set to reveal her spending plans for the next, 3 years for some of it, but further ahead for some of the other buckets of spending. Reeves will defend her fiscal choices in the face of a weakening labour market and declining political fortunes. Let's speak to Dame Meg Hillier, Treasury Select Committee Chair for the UK's House of Commons. Meg, very nice to have you with us. Thank you for joining us. So your role at the Treasury Select Committee is to kind of hold the Treasury to account. You'll be wanting them to spend money on certain things, the things that make a real difference for the UK economy. So what will you be watching for?
Well, I think we've had a lot of them already announced. Obviously, there's big announcements on capital expenditure. And I think today we know what the total cake is. That was laid out last November, trimmed a little bit, reconfigured a little bit in the spring statement. Now it's how it's carved up. And we've obviously seen extra boosts to the health service and to defence, among others, and other announcements in the last week. So it'll be what we'll be looking for is where the trade-offs are in the departments that haven't had that kind of special treatment, if you like. What's really important, though, for everybody to understand is this was a zero-based review. Each department had to go through every corner of spending and decide what its priorities were, and then discuss that with the Treasury. So we may see, and the bit that probably won't be announced today, is certain things that are actually just dropped or reduced or slowed down because they're just not a priority for a new Labour government. And so this will set out really the direction of travel and the values of what a new Labour government wants to achieve over the Parliament and beyond.
Okay, and we're not going to be dealing with new estimates about how the UK economy grows today, Meg. That's a different process, as you set out around the budget and the OBR. But do you have concerns around that? And will you, as the Treasury Select Committee, be chasing that kind of clarity? Because we got Labour data yesterday, which showed a drop in the number of jobs in the country, the biggest in 5 years. Retail and hospitality in focus. A lot of people saying that some of the policies that were brought in the last budget are having this chilling effect on the labour market.
Well, obviously, I mean, the government has set its highest priority as growth. So when the Chief Secretary to the Treasury, Rachel Reeves, #2, appears in front of the committee in 2 weeks' time, we're obviously going to be asking how this is going to deliver on that growth agenda. So we'll be looking at the public spending envelope. But, you know, I guess what he'll say is the infrastructure spending will boost the economy. We need to be pushing about how clear they are that it will actually be delivered on the trajectory that's promised. So, for example, some of the transport links in Manchester and the North East, if they're delivered on time, that can bring in private investment. And we've seen that when you look at HS2, when that doesn't happen properly on schedule and there's a lot of uncertainty about it, that dampens down or reduces or even nullifies completely that private investment. You need to have that confidence. So we will be pushing on that. And another thing we'll be looking at as well is, you know, it is important that the public purse manages and trims its budget according to what's available, as are the general public when it comes to the cost of living. So when they make promises about efficiency savings, we'll be drilling into that, because often that can be a shorthand for government for, you know, we hope this will happen, but delivering efficiencies in government is the holy grail, but is not always as effective as promised at moments like today.
Investors, good morning, Meg. Thanks for your time. Investors will also be looking ahead, or have one eye on the autumn budget. We've had the IFS coming out, the Institute for Fiscal Studies, suggesting that there will have to be, and I'm quoting, chunky tax increases in that autumn budget. Is that now the likely prospect, given that the Chancellor has committed to those fiscal rules?
Well, I mean, the Chancellor, as you say, is very clear that she's committed to the fiscal rules. Now, I have to say, it would be unusual for any Chancellor to change them within the first year of government. But Chancellors do change fiscal rules over time. You know, they don't last forever. A fiscal rule is what the Chancellor said it is. But I think she's been pretty clear that she wants to has set those and wants that as part of her base of stability, her promise to keep things stable and to manage public money. Look, I'm not going to start predicting what taxes she may or may not raise. She has been very clear, and it was in the Labour manifesto, that certain taxes would be untouchable, and that's something that both major parties were saying in the general election. So there is very limited scope. I think that you know, the other option is to discuss whether there are further changes, but this spending envelope that's been set out means that spending is set. So I'm imagining those discussions with the Treasury were very tough. As we know, some of them went right to the wire. Departments really pushing for their priorities, and it's very difficult if you're the Home Secretary to say what's not important or as important in your department as others. But I think if these spending rules are tight and set out and the spending review works, then she may not need to do as much in the autumn. But look, you know, Chancellors have to juggle taxes, investment, growth. They're looking at all of these things, and she will be, you know, she's obviously going to be hoping that some of the announcements today will lead to more confidence, investment, and boost those employment and growth figures.
Meg, how acute is that debate right now within the party about the need to shore up the welfare and the U-turn that happened, of course, on winter fuel allowances, versus those close to the Chancellor who want that fiscal probity?
Well, I think actually there's certainly a general understanding, especially after the Liz Truss mini-budget in 2022, about why fiscal probity matters. If that was ever a reminder, you know, that was a stark reminder of what happens when things get out of control and how fast things can get out of control, and actually the role of the markets in this, that this market sensitivity really matters. That said, you know, this is a new Labour government, and a lot of new Labour MPs, as a big majority, coming in, wanting to see the changes that our constituents have been asking for a very long time. We see the poverty, we see the housing issues. So those things will very much matter. So that is the challenge. Chancellors are never usually, you know, making popular decisions, because everyone sitting down in front of the Chancellor would have a bidding list for their constituency or their region or their country, and she's got to make sure she manages that. So I think that it's not impossible to do both, but it will be hard choices, and that's what the committee will be examining in the next couple of weeks. You know, what choices are being made, and we need to have honesty about what's not being done as well as what is.
Okay, Meg Hillier, appreciate your time. Thank you very much indeed. UK Treasury Select Committee Chair. Don't miss the launch of Bloomberg Tech Europe, by the way, this Friday, 6:30 a.m. London time. That is it for opening trade. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jemana Versace in Doha, Qatar, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. The U.S. and China agree on a framework deal to ease trade tensions, ready for sign-off by President Trump and President Xi. Elon Musk says he regrets some of his posts about Donald Trump last week, saying, quote, they went too far. Plus, the UK Chancellor will defend her fiscal choices and announce billions of pounds of infrastructure investment in her spending review. So there's quite a lot of news out there. Let's look at the markets and see the road over for that. Now, overall, this is a picture for S&P futures. You can see down 0.2%. Look, they're sleeping after the outcome of some pretty pivotal trade negotiations. They were here in London yesterday, and they lacked a bit of detail. The detail probably needed to lift markets hovering near all-time highs. The U.S. 10-year yield at 4.4858, and you can see a sterling ahead of that spending review. We already have a pretty good map or idea of where the chancellor goes. That's coming up at 12:30 today. Sterling 134.81. Now let's also take a look at the European markets map. Now this really is tailing what is going on in the U.S. Financial markets, again, closely watching whether the world's two biggest economies could find a way to tamp down tensions that, of course, economists say have tipped the global economy into a downturn. The CAC 40 gaining some 0.3%, similar gains for the DAX, and then the FTSE 0.1% higher. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. and China have agreed to a preliminary plan to ease trade tensions, which now goes for approval to the nation's leaders. Now, American negotiators say they expect issues concerning rare earths and magnets will be resolved.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
Let's get more now with Lizzie Burden. So, Lizzie, what we know about the discussions is that we're close, but we like details.
Exactly, Francine. We just want to see what they agreed on paper. We had 20 hours total of negotiations, and you had Jameson Greer, the US Trade Representative, and Howard Lutnick, the US Commerce Secretary, emerging after midnight to tell us that what they've agreed is a framework for implementing the Geneva Agreement, that 90-day tariff truce through which we're about a third of the way now. But as you heard there, essentially what they have agreed is that China is going to send more rare earths to the US, and in exchange, the US is going to roll back some of its export controls. So it's good news. They're not decoupling, but Greer also said there aren't more meetings in the diary yet, so we're not out of the woods yet. And I've been saying all morning, Francine, I think what we've really learned in the past few weeks, and in London as well, is the importance of export controls in this trade war. Donald Trump may love the word tariff, and indeed that court may have ruled that he can proceed implementing his tariffs, but Beijing has just shown us how much leverage you can wield using export controls. So now we look for a grand deal, and we know that they can take even 18 months to negotiate, as we learned in the first term of Donald Trump's administration, to get to that phase one deal. Could be a long road ahead.
It could be a long road ahead. Lizzie, we're also hearing that EU trade negotiations could actually extend beyond the deadline with Trump, so that's also moving in the right direction.
Exactly. It's the same story here, essentially. 2 weeks ago, you'll remember, it was said by both sides that they wanted to fast-track the negotiations, and Greer, Lutnick and Maroš Šefčovič, the EU's chief trade negotiator, have said that they're going to meet in person. But just this morning, our colleagues Alberto Nardelli and Jorge Valero report that actually Brussels sees that July 9th deadline for the so-called reciprocal tariffs as the best-case scenario for when the US and the EU can reach a deal. And Francine, that's because there is just so much to talk about. There's tariffs, there are non-tariff barriers, and there are so many critical sectors, whether that's chips or pharma or aircraft or autos as well. And so in the meantime, you've got the EU preparing its retaliatory measures. There may be a bit of cooperation on critical minerals, but it comes back to the same point. These talks could go on for much longer than Donald Trump bargained for.
Lizzie, thanks so much. Lizzie Burden there with a terrific roundup of the trade negotiations. Now, from trade to fiscal policy here in the UK, the Chancellor Rachel Reeves is set to reveal her spending plans for the next 3 years. Reeves will defend her fiscal choices in the face of a weakening labour market and declining political fortunes. Well, we're joined by Andrew Balls, PIMCO's Chief Investment Officer for Global Fixed Income. Andrew, as always, thank you so much for joining us. I mean, first of all, there's been a lot going on in bonds, right? I don't know whether it's the divergence between ECB and Fed, but where do you find opportunity in this kind of market?
Yes, so lots going on. Always interesting these days. Washington, D.C. in particular, keeping things interesting. You've seen markets price close to the end to the easing cycle in for the ECB. We've seen an adjustment recently in Australia. We saw an adjustment earlier in Canada. So it's the UK and the US which stand out. Global markets, higher terminal rates, and I think in the UK case, that looks wrong to us. We would expect this adjustment over time. It's taken longer, partly because of some of the government policy, some of the inflation persistence, but our expectation is moving forward, we should see a pricing lower in terms of the terminal rates for the Bank of England. So the UK looks like a very interesting market to us.
Okay, so what do you buy? I mean, is there anything that you buy in the UK market with conviction?
I think the 5-year part of the curve looks a good place to be. Terminal rates close to about 3.5% in the UK. It could easily be 50, 100 basis points lower than that, given the growth profile. Of course, you need the inflation data to cooperate. You need the shift on the part of the Bank of England. The chief economist, Hugh Pill, of course, recently warning his concerns on stubborn inflation pressures. Our expectation is that will happen. You are seeing mixed messages, but cooling in terms of the labour market. So again, the Europeans got there first, but we think that the UK will catch up, and that looks like a good opportunity.
Andrew, how much does it depend actually on what we have actually in the spending review? I mean, there's a number of forces, right? This is a small open economy. It's extremely, in the middle basically of trade wars, but there's also the government doing certain things.
Yep. So I think that the trade war's somewhat less of an impact in the UK. There isn't a trade surplus, big trade surplus with the US in goods, so that's important. So we've revised down our global growth numbers, but less so for the UK. Fiscal, I think, the statement today is very important as a political event, and we'll see government priorities in terms of the political event. In terms of the market event, we've had the spring statement. We'll have the budget in the autumn. Those are the market relevant time. So unless there is a surprise, I guess there could be a surprise. Unless there is a surprise today, we actually know what the fiscal envelope is. This is more about division, the government's political priorities. So shouldn't be a significant market event, again, unless there's a rabbit out of a hat.
How much do you worry about the U.S. economy? Again, it's some of the data points are weakening, but actually there's still a mismatch between surveys and data. So does the gap narrow?
So when you have a shock, you would normally kind of think 3 to 6 months before you see that in the hard data. Right. So you're certainly seeing the weakness in the surveys. So it is now and over the summer that we should see the impact. We've revised down our growth forecast a lot in the US. Markets don't like uncertainty, but business decision makers don't make uncertainty. And as with your reports there, it's kind of clear as mud exactly how this is going to work out. Equities have recovered. I think markets are pricing in a baseline, which is something like 10% across the board tariffs, and then somewhat higher sectoral tariffs, something higher for China. And, markets don't like uncertainty. As you get clarity in terms of that baseline, you can price to that baseline. I think equities are priced to that. Given that the strong recovery we've seen, I would see the balance of risks to disappointment versus upside risk, but it will have an impact on growth. For the Fed, the labour market's going to be very important. The labour market over the summer is going to be inflation data this week, of course, but the labour market, I think, for the Fed, again, 3.5%, 3.4% terminal rate for the US, looks somewhat high to us, and given the scale of the uncertainty, you certainly can see the risks skewed towards somewhat lower policy rates. But I mean, I think the simple thing from our point of view, high quality fixed income, 5 to 7% type yields on a core bond portfolio. If you look at actively managed funds in an uncertain environment, making 5 to 7% on global bonds, US aggregate bonds is, very, very attractive, we think, in terms of the potential returns.
Andrew, there's nothing funny about an auction going badly. Do you worry about auctions? I mean, we could see, treasuries, but also Japan and elsewhere.
So the auctions have become a significant event. We have the 30-year. Japan is really interesting. The steepening of the curve in Japan looks very interesting indeed. Don't worry about it too much. Just kind of deal with the consequences. The level of yields looks attractive. We would think the 5 to 10 year part of the curve in the US is where you want to be. Plenty of room. We've got the big, beautiful bill coming up. Plenty of room for more risk premium to be priced in at the long end of the curve. So be in the 5 to 10 year part of the curve. Japan does look like an opportunity. The authorities there are going to need to reduce the 30-year issuance. the market, the Japanese domestic investor base doesn't need the same supply in terms of 30-year bonds. This is something we see in other jurisdictions as well. So you need the Japanese authorities to signal clearly the reduction in long-end supply. But given the extreme steepness of that curve, we see this as a good opportunity. It's a trade, it's not a long-term investment, but a good opportunity in the 30-year part of the Japanese curve.
Andrew, I know Elon Musk apologized or said he went too far in some of the tweets, but bottom line, he was worried about the big, beautiful bill and what it does to fiscal. I mean, do you share concerns?
So when you look at the long-term, outlook for fiscal balances globally, the US does stand out. US, France, Belgium actually stand out as a long-term path towards much higher levels of debt. I think that in the short term, we're not going to see any shift, certainly under this president, and we have tax cuts to come. I think there is a longer-term issue. So for now, the 5 to 10-year part of the curve anticipate more risk premium at the long end of the curve. I think that makes sense. The thing in the US, again, contrasts with France. In France, tax levels are very high. Yeah. It's going to be hard over time to address the issues there. In the US, tax levels versus history are not that high. So it's about political will. Again, I'm not sure this will happen in the next 3.5 years, but over time, it should be relatively straightforward from an economic point of view to adjust the US fiscal outlook. It's just about the political will.
And overall, I mean, the market, gets jolted, or the auction, the bond market is kind of in a panic for a couple of days, and then it, gets composure back. Are you expecting this to just be the way we operate over the next 6 to 12 months?
I think the kind of step back a little bit from the screen and don't fret too much about the noise. A year ago, the 10-year Treasury yield was 4.5%. Today, it's 4.5%.
Deep breath.
Keep calm and carry on. Now, it's an unprecedented, I think, environment in terms of the uncertainty emanating from the US for global markets. The politics is driving the economics and the finance. Often you think that finance will drive the political process, but it's the other way around at the moment. I think that there is the room for more risk premium in the long end of the curve. But again, if you can get 5 to 7% type yields on high quality fixed income, this looks like a very good position to be in, given all the uncertainties. We've basically halved our US growth forecast for this year. Hopefully the trade negotiations globally will lead to better outcomes, but they could lead to worse outcomes. So I think that the high quality bond portfolio is attractive return and good downside protection in the worst, in the event of worse than expected outcomes.
Andrew, thank you so much for joining us. A lot to go through there. Andrew Bowles, PIMCO's Chief Investment Officer for Global Fixed Income. Now, coming up, some of our conversation with Steve Schwartzman, the Blackstone Chief Executive, on tariff deal-making and why Europe, he sees a major opportunity for the world's largest alternative asset manager. That exclusive conversation up next, and this is Bloomberg.
up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Well, Blackstone is planning to invest as much as $500 billion in Europe over the next 10 years, another sign of the continent's growing appeal to investors during a period of geopolitical flux. Now, in a wide-ranging interview, the chief executive, Steve Schwarzman, also spoke to us about AI deal-making and the impact of tariffs on the economy. The world's largest alternative asset manager is marking 25 years of operations in London.
You know, we started here with no one. We now have 650 people here in our office in London. We're building a very significant new headquarters in Berkeley Square. That's probably going to be the nicest office building that's been built really since the wonderful Bloomberg headquarters here in London. So that's worked out. We're in a lot of different business lines, and we have a very positive view of the future here in Europe. We think we're going to be able to invest $500 billion over the next decade in Europe. We see it as a major opportunity for us. They're starting to change their approach here, which we think could result in higher growth rates. So this has worked out amazingly well for us.
Where do you see the best opportunities in the UK and Europe? Is it certain sectors? Is it certain parts of the economy?
Well, we see in real estate, there's always opportunity as you go through cycles. We've been looking on a global basis with very similar themes with artificial intelligence. I see that Jensen Huang was here meeting with the Prime Minister at a tech conference and was talking about how the UK needs to invest more in infrastructure. Blackstone is the world's largest developer of data centers. And we're also the world's largest owner of data centers. So it's been a really core business for us.
It's been a pretty subdued year overall for deal making. So how do you approach monetizations, for example, at a time of heightened demand for liquidity from investors?
Well, we're in a cycle now where the markets haven't been accommodative to IPOs, and strategic sales to other private equity firms are difficult because they're having difficulty raising money. Fortunately for us, we finished our money-raising cycle, so we've got lots of money at the firm for these things. We're in an unusual position. But I think we sort of look at these things and say we sell companies when we think it makes sense. We've actually sold a good deal, surprisingly. It's because we have some very good companies with very good results. And the rest of it is involving putting more money into businesses to make them better.
What have you seen since Liberation Day in terms of, deal making? You were broadly supportive of the tariffs by the Trump administration. Given the volatility, any second thoughts?
I think, what have we seen? We've continued to be buying things because we're long-term owners of assets. And when other people get somewhat disoriented or sort of pessimistic, we view the tariff situation generally as something that will be resolved over the next 6 to 9 months. And there are negotiations going on with lots of different countries. They'll happen at their own pace. But if you look at a world with an assumption that the tariff issues will find their way, and even if you end up with a base level of 10%, that'll be absorbed, with currency moves, with the shippers, manufacturers of product eating some of that cost, and the American consumer, eating some of that cost. You divide that 10% up 3 ways. It doesn't have a huge impact on inflation in terms of global growth. There may be a few tenths of a percent of change, but overall, it's something the world can absorb, and we'll be going on to be doing more buys of companies and other assets and sales as well.
Do you think some of these tariffs change the economy for a long time, that there will be consequences?
There will be consequences. It's meant to be positive for the United States, which is why the administration's initiated it. How quickly the good parts will happen, those always take a while, and you could have some slowing for a quarter or two as we go through this. That wouldn't surprise me. But for us, as longer-term investors, who don't get quite as excited as people do who are trading securities on leverage on a daily basis, that's enough to make one nervous. For people like us, we look and say, okay, what's going to happen overall to economies? What's going to happen to the world economy? Slowing for a quarter or two, in the great sweep of it, doesn't make that much difference.
Steve Schwartzman, there, Blackstone's chief executive, speaking to me earlier. Now, Elon Musk says he regrets some of his posts about President Trump. A public feud erupted last week between Musk and Trump over the president's massive tax bill. Now, we're joined by Joshua Gallu from Munich. Josh, you've covered politics in the U.S. for many years. Where does this leave Musk's relationship with President Trump?
Well, Trump is a very transactional personality, right? So he has fought and mended fences with many, many people in the past. It depends on what that person has to offer him politically or otherwise. So, this was, of course, in the fallout was spectacular, as many people had predicted it would be. And Musk has a lot to lose. So when he went to the mat with Trump on social media, there was it seemed somewhat inevitable that he would eventually have to back down with the amount of government contracts and exposure that he has to the government. And you combine that with the willingness of Trump to sort of never back down in that kind of spat. And, what happened. But I think that, Trump has shown in the past that he is willing, when there is a deal to be made or something to be gained, he is willing to go back to the mat.
So, and meanwhile, in L.A., the city also imposed a curfew overnight as protests stretched into fifth night. What's the latest and what can we expect?
Well, that situation has escalated quite dramatically over the last few days. Of course, we now expect Marines to be on the streets as of today, and that will bring the number of troops to a very high level. There's a curfew, as you just said, that the mayor has imposed. And this is really a high-stakes conflict here, politically and also just in terms of the nation's view of what's happening over time during the Trump administration. So, the Gavin Newsom, the governor of California, has sued to stop the use of National Guard, and that we'll see what happens in the courts.
Great, Joshua. Thank you for the terrific briefing. Joshua Gallo there with the very latest from the U.S. Coming up, the UK Chancellor sets out her spending plans for the next 3 years. We'll be speaking to the Resolution Foundation CEO on what we can expect. That's next, and this is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, the U.S. and China agree a framework deal to ease trade tensions, ready for sign-off by Presidents Trump and Xi. Elon Musk says he regrets some of his posts about Donald Trump last week, saying, quote, they went too far. Plus, the UK Chancellor will defend her fiscal choice and announce billions of pounds of infrastructure investment in her spending review. Now, more on that story now. The UK Chancellor, Rachel Reeves, is set to outline how £600 billion of annual spending will be allocated across departments over the next 3 years. Now, this includes a £300 billion uplift for areas such as healthcare, education, and transport. In a bid to draw attention to the rosier parts of her spending review in recent days, the government has trailed announcements, including investing £14 billion in Sizewell C nuclear project, £86 billion in British science, and committing $15 billion for new transport infrastructure across the North and Midlands of England. Now, the government's approach to public services have come under scrutiny with the tax burden at a post-World War II high. Well, for more on all of this, we're joined by Ruth Curtis, Chief Executive of Resolution Foundation, and Dan Hansen, Chief UK Economist at Bloomberg Economics. So thank you both for joining us. Dan, get us started. I mean, this is exciting, but actually not really. I mean, I was just speaking to Andrew Balls, and he was like, look, it's not a market event like the budget is, but it gives us an indication of, I mean, we could see surprises, and it gives us a good indication of what the Chancellor is thinking and seeing.
Yeah, I think that's right. I mean, no one expects there to be any extra borrowing announced today. Of course, there's always a risk that happens.
But they would have
Obviously,
briefed us.
You would hope so, but we're not short of surprises on fiscal policy here in the UK. So but I think the base case is we're not getting any extra borrowing. So it's about divvying up the pie. It's about on day-to-day spending. The big question is around basically how big is the health budget going to be, and what does that leave for everyone else. And I think on capital spending, we've got a lot of information there, but that's going to really be around the government's growth story. Where is this money going to go? We had in the spring statement, or the spring forecast, I should say, this big, relatively large increase in defence spending. That's taken up a bit of a chunk. So it's how they apportion the rest of that capital investment budget. And then really about the narrative around growth, because that's really what this government has said it's about. Yeah. But we're waiting to see the sort of spoils of that effort.
Yeah, and Ruth, and welcome to the program. I think it's also to understand actually what kind of government they want to be, right? So it's the vibes that they're going to give. Are they more capitalist? Are they more labor-leaning?
Well, exactly, and as you say, it's not a market event in the sense of borrowing, but it's really important for the country because it's really deciding of this quite significant increase in public spending compared to previous plans that the Chancellor penciled in. How is she going to prioritise that? And because the spending was quite front-loaded, so we've had quite rapid growth in public spending over the last few years, but the growth rates for the period that this spending review is about are a lot tighter. She will face really tough trade-offs, exactly as you said, between health and other areas, and even within her expanded capital budget. So we'll learn what she really cares about.
Ruth, the world's changed, frankly, since Donald Trump came to power with tariffs, Liberation Day, whatever you want to call it, just a lot of turmoil. Is there anything that you think the Chancellor regrets or that she would have done differently with hindsight?
Who knows? But I think one thing to bear in mind today is the OBR didn't take account of any tariff action in their last forecast. So when we look ahead to the autumn, we'd expect that's the first time they take that on. That's presumably going to mean a downgrade to their forecast. And so we've heard a bit from the government about the improving economy, meaning they can afford things like winter fuel payment, and that doesn't really stack up with the sequence of OBR forecasts.
Yeah, and at the end of the day, again, when you look at what bonds are doing, this is like the fiscal reality, is that it doesn't live in a bubble. It's faced with market movements on a day-to-day.
Yeah, absolutely. And if you look at global markets generally, I would monetary policy is always important. Of course it is for fixed income, but fiscal policy has become really important as well. And you just have to look at that. The UK has been an example of this. We had a big flare-up in 2022. We had a flare-up at the start of this year. Obviously nowhere near on the same scale, but people were talking, Trust 2.0. It didn't prove to be the case. But if you look at the US as well, there's significant interest in what the Trump administration is going to do on fiscal policy. So the UK is a price taker in global markets. So basically what happens in the US feeds across the Atlantic to the UK bond market. And the OBR, as Ruth said, takes that on board. And there is a big question not only about where we will be with interest rates, but also about the outlook for the economy, and particularly, I know it's nerdy and in the weeds, but what they say about productivity growth, how fast the economy can grow in the medium term. Because if they decide to make a change to that, it will mean a big change to the government's fiscal outlook, and the OBR has been very optimistic about that. So that is a big risk the government has hanging over it going into the autumn.
Yeah, and I want to ask you a little bit about growth in a second, but also she needs to make a difference for lower income families that have been struggling for so long.
Yeah, absolutely. And when you look through the spending review, because spending is growing in real terms, despite all the talk of austerity, when we look at the benefits in kinds to households, we think those will rise through the spending review by about £250. But what that delivers in terms of public service outcomes will depend a lot on how she allocates it, on things like how much public sector pay is eating up that money.
Yeah. But overall, is this just tinkering? Because there's not a huge amount of money. Like actually in whatever she does, and we'll talk about growth, but defense, there's just nothing radical that she can do.
What her plans involve is basically the state saying roughly the same size, right? Departmental spending is basically goes up a bit and then down a bit and is constant through the forecast. So on the other hand, a government can't really do more than that unless it does want to put taxes up. So I wouldn't call it tinkering. In some ways, she's looking at the books bottom up and saying where her priorities lie.
I like your piece, Dan, that you wrote with Anna Andrade, looking at basically, this is another chance for the government to show that they're serious about growth. Is this well understood within government, that they're also speaking to, I guess, investors and international community?
Yeah, absolutely. I think it is, because it goes back to the point in the previous question, is that there is a relatively fixed amount of demand for an increasing amount of supply of fixed income going into the market from governments. All governments are running very wide deficits. So you have to make the case to global investors why you are a better case than another country. And that's around saying, is this investment going to give a good rate of return? I think the challenge the government has, and we all know this, is that investment spending just doesn't yield return very quickly. Right. And over a 5-year period, when you're worried about getting re-elected, that's a really big challenge. We all know it's the right thing to do, but the economics doesn't necessarily stack up with the politics in that world.
But another 4 years in charge feels like very stable compared to other parts of the world.
It does. But it's also a very unstable, I would say, political environment with what's going on with reform and the like, where Labour are really focusing on trying to sort of sort that and stem that flow in the polls. You've already seen them announce something on migration, which is a real pivot. So there are the things that they came in and were voted in to do, and then there's the sort of day-to-day, as Ruth said, global trade war. Yep. That's something they're going to have to focus on. And I think the past few governments particularly have fallen foul of having to just deal with the events of the day and just put to one side the sort of longer-term strategy. Hopefully today we get a better sense of that over the next four or so years, particularly, as I say, when it comes to investment spending.
Yeah, affordable homes is really, part of central to their strategy. Will they manage?
So what we've heard this morning is a sort of dramatic total number of 30-something billion on affordable homes. When you look at what that is per year, it looks like it is, and we'll get the detail later, about a doubling in spending on affordable homes compared to the last few years. It takes us to about 2008 levels. So it's both a big increase in spending and I think still questions about how much of that 1.5 million homes will be in affordable homes versus other kinds of housing.
I mean, I live in Southwest London. Actually, they're building like crazy. And this is really the council, over the last 5-6 months. I've never seen building works go up so fast. Defense. I mean, this again is a huge. There was a NATO summit. How much spending could they do on defense? Well,
I think the starting point is that we're going to hear. We know they're going to 2.5% of GDP by 2027. There's this aspiration to get to 3% at some point in the next parliament. They've been back and forth about whether it's an ambition or a commitment. It's possible. There's more detail on that set out today, how we get or when we might get to 3%. That might be, one of the sort of, as they say, rabbits coming out the hat. But there will still be this big question about, we've got the NATO summit later this month. There's still that gap. And if you're thinking about the holes in this plan, the fiscal holes, defence is a big one, and the sort of usual one that everyone talks about is unprotected government departments, the real terms cuts in departments other than, say, health, education and defence. And they're the two fiscal holes that people will begin to talk about, and knowing the British press, it will quite quickly turn to at what point taxes will have to go up, and talking about how difficult the autumn budget's going to be.
How can she manage that? Can she manage that?
Well, so it really is, as Dan said earlier, all about how quickly she grows the health budget. So the long-run growth rate for the health budget is about 3.6%. If she were to do that, then there would be real terms cuts elsewhere. It is possible for her to contain that to more like recent growth rates, and then she could avoid, apart from the aid cuts that we know are coming, real terms cuts elsewhere. But obviously, just maintaining your budget constant in real terms is not necessarily enough to deliver huge ambitions for public service reform.
Ruth Curtis, Chief Executive of the Resolution Foundation, and Dan Hansen from Bloomberg Economics. Thank you both for joining us. Now, Inditex shares tumbling this morning after the Zara parent company reported a muted start to the second quarter in its latest earnings release. Charlie Wells is here with an update. Charlie, what does today's report mean for Inditex?
Francine, well, the market really is not liking what it's seeing in this report. Inditex is the worst performing stock in the Euro Stoxx 600 this morning. And really what we saw in this report was a slowdown in revenue growth. This has been a trend over the past few quarters. And really this report did not show a divergence from that. We also saw a tepid start to this all-important summer sales season, so slower than last year despite growth on that front. And what is notable here in Inditex is in this earnings report, they talk about a hit of 3% to revenue on FX concerns in the year ahead. So this is a concern that a lot of European companies have had because of the strength of the euro, given this FX headwind. So this is panning out for Inditex. And what this report, bigger picture, shows overall is this narrative that we're seeing in the fashion space. After all of these earnings report, investors have sort of been struggling to put this together. And what we're seeing here is really three tracks. So on the upper end, on the Kering front, on the LVMH front, you're seeing pressure. On the Inditex front, on the H&M front, sort of on that lower end, you're seeing pressure as well. But it's really in that mid-market, in that sort of Ralph Lauren, the kind of Michael Kors, the Kate Spade category. That's where you're seeing a lot of success as consumers trade down, but are still looking for a little bit of luxury, but at a much more kind of valued price point.
Elsewhere in retail, Nintendo reporting a sales record for its new Switch 2 console. What do we know?
So we know that in just 4 days, Nintendo managed to sell 3.5 million of those Switch 2 consoles. Now, this is all important for Nintendo because they derive some 90% of their revenue from Switch. So this is a debut that is very important for the company to keep that revenue growth going. It's been 8 years since they launched their Switch, and actually, those sales figures in just 4 days are better than what that original Switch managed in the first month when it debuted in 2017. So this is important for Nintendo, but it's also important for the gaming industry as they try to look at trends. These consoles are important not just for the hardware itself, but for the software, and this sets a tone for the gaming sector. So competitors, including Sony, including Microsoft, are going to be paying a lot of attention to these sales figures.
Charlie, thanks so much. Charlie Wells there with some of the retail companies. Now, coming up, we're in conversation with Joe Davies, Vanguard's global chief economist. We'll get his outlook on the economy, but we'll also talk AI and the megatrends affecting investing. That's next, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's not easy to say that before we know how the end game will look like in terms of the tariffs. And it's not only US, Europe, it's also China and the rest of the world. Trade is a very complicated thing because whenever you put some kinds of the barriers to a free flow of goods or capital, then there are trade diversions. So we will have to see how it all ends.
That's Boris Vucic, Croatia's central bank chief and ECB governing council, speaking exclusively to Bloomberg. Now, the turmoil that hit markets after President Trump's Liberation Day tariffs may have faded, but uncertainty continues to worry investors. A deadline for increasing the U.S. federal debt ceiling is looming. Trump's tariff exemption ends in under a month, while concerns are mounting about the implications of Trump's deficit hiking tax bill. Well, we're now joined by Joe Davies, Vanguard's global chief economist and global head of the investment strategy group, also newly minted author, a new book that came out, Coming Into View, How AI and Other Megatrends Will Shape Your Investments. I have it here, Joe. It's a great read. It's a short read. I urge everyone to pick it up. So congratulations on the book. I mean, this goes down to, it must have been a difficult book to write because it's actually right on the money on what's happening now. So you have to make it, long-term, but also focusing on some of the quirks that we're seeing.
Well, again, really the focus next 3, 5, 7 years. What I think I'm proud of is that it's a data-driven framework. So this is not just my qualitative assessment. Maybe I'm pessimistic one day, optimistic the next. But ultimately, it is a tug of war. It will be the economic investment landscape the next several years for every country between AI and the deficit spending. So I think what we saw last month, the concerns in the U.S., in the U.K. last year, is a glimpse of one potential future.
Yeah, and this is what fiscal concerns.
Yes.
That fiscal concerns are just not being taken seriously.
Structural deficits matter. And structural meaning they're ongoing, they're chronic, and they don't look like they're going to stop. And it's important to calibrate that. When you do that, they raise inflation expectations at the margin and induce central banks to try to fight it. Now, you can extend that dynamic or avoid that dynamic, like the United States in the 1990s, if you get technology to kind of bail you out. And that is the horse race and the tug of war that I talk about.
Joe, what I don't understand at this point in time is that we talk about, there's moments in stress in markets, and we talk about shifts and everything changing in the New World Order, but we're not really seeing it in markets. And is that because it's too difficult to compute or to price in, or is it because they're waiting for some kind of event?
I think it's both, Francie. It's actually a really poignant question you have. I think there's a lot of noise in the near term.
Yeah.
There's also, it's tough to detect shifts until you see more and more data and evidence. Think of the late 90s. And so AI, we know, more likely than not, it's going to be transformative, but there's still doubts. There's like, well, what's it doing for healthcare? What's it doing for finance? And so you have always healthy skepticism. But again, what I think investors should try to see is that there is very likely to be a fork in the road in some of the macro dynamics. And it's not to be alarmist, but how can you think about orienting your portfolio? Because the markets are certainly not prepared for the economic diagnosis that we have.
Okay, I mean, treasuries are safe until we ask ourselves if they're safe.
Yes.
Again, does this go to structural reforms, fiscal? I mean, this is what your book will try. Your book tries to also tackle head on, and what you do day to day.
Yeah. Well, and again, we were very proud. We spent a lot of time the past 2 years. We were among the first firms to say, listen, interest rates were likely to be permanently higher 2 years ago because of some of the structural deficits building. It's what's called higher R-star. They don't need to continue to rise if you can have some of these growth thrusts. But again, that's where this tension is. Fixed income will still, again, the bonds are back, and that's been a theme for us for 2 years. But the fiscal dynamic bears watching, and there's ways that you can navigate it. There's actually greater risk in the equity market in the U.S. from the deficit dynamic than there is in the bond market.
I mean, you also argue that basically you need this AI revolution to get us out of the debt problem, because I guess if you grow to buy time, because of productivity.
Yeah.
But how do you look at AI? Because it could also, you could lose a lot of jobs. It could transform an economy, not necessarily for the best.
So in our diagnosis, roughly 20% of the occupations will see significant job loss. That's good for productivity. It's tough for disruption. More industries than not, however, will actually see more augmentation. Think Copilot.
No.
That was more like the personal computer. It's still early in our J-curve. There's also really eye-opening investment ways to play it. If you think of the technology cycle in the second half, a lot of focus on the Mag 7. The smart money, in my personal judgment, is outside of tech if AI is going to be transformative.
Where? In insurance? I mean, could it be like as far-fetched as
You start at the value funnel, so healthcare, finance, thinking some of the... Again, we saw this in every other technology cycle. There's the AI production.
Yes.
That's a lot of some explosive growth. what we have to look for is the AI consumption. If it's going to be transformative, general purpose technology, tell me how profitability outside of Silicon Valley is going up. If it hasn't gone up, then we're talking about social media effects, which is close to zero.
So, I mean, it's my understanding. I mean, I had this great conversation actually with the founder of DeepMind, that's now owned by Google, and he was saying it's too early to say who the big winners from AI are. So, how do you, understand who the second and third round effect winners are?
Well, that is tough to diagnose. I can tell you we're probably, forgive the American analogy, we're in a third inning of a 9-inning game, which is why it's not baseball. So apologies to all the cricket fans. But again, it's still too early that it will be transformative, but that's where it points to. And so there's ways to navigate this. I would tell you, though, diversification, if you're sitting in the U.S., has been a tough argument to invest outside the U.S. Our analysis clearly points in that direction.
What, just for diversification? So it's like almost a natural hedge.
Again, with this tug of war, we are effectively saying there's an 80% probability in the next 5 years that U.S. exceptionalism is over. That's a pretty bold statement given our analysis.
When you look at markets, I mean, is the bond steepening trade to consensus at this time?
I think so. I mean, I think what you have to think about is what's the Federal Reserve or the central bank's reaction function to this? If we know that structural deficits have some push-up on inflation, certainly the long end of the bond of the yield curve, but the UK and the US, we know from our analysis, it's modestly put up inflation expectation. That brings central banks into fore. And so I think what you're talking about is tension over the yield curve between fiscal spending and monetary restraint. That, I think, is thematically what the environment we have already started to enter and will live with for the next several years.
Yeah, I mean, speaking of several years, the AI, there's, again, a lot of question marks on whether it does buy the U.S. time.
Yes.
Is there, in terms of timeline, when do we find out whether this experiment is actually good or not?
That's always the big question. So I'll put a range. I'm going to use my hands. I'll put a range, but I will answer the question. Our analysis is rough. It's not on today's doorstep. But if you look out 2028, 2029, 2030, you have to have structural deficits roughly 8 or 9%. We're not there yet, but we're not that far away. So I'm not going to be alarmist. We're not talking about material further spike in interest rates in the United States in the next year or two. That would be a surprise to me. But these pressures are building.
And productivity, I mean, I've been talking about the productivity puzzle, I feel like all of my lifetime.
Yes.
Does it really get resolved with better use of AI?
We will know in 3 years whether or not AI is more transformative or not. It's not just going to be an automation front, Francine. We got to talk about new industries. So what I'm looking for is what are the new products that are coming out? Because at that point, we'll start entering the same period of time where the computer, the transistor, or the combustion engine, you started to see those knock-on effects. If we don't have the knock-on effects, then we're talking about more marginal boost to growth, hence a little bit more pressure on the fiscal side.
But so what's on, to get those knock-on effects? Is it, because I've heard, it's basically every employee being able to program an app to help them with what they need.
Yes.
Is that the big gamble?
It's that, but I think there's even more. It's what new industries or products are created. So I'd be looking in healthcare. I haven't seen much new medicine or treatments. The human researcher is in the loop, but what additional insights as a power tool did it help? You got to look at energy, and you got to look at finance, what new products. So again, that's areas I would be thinking about. Education, areas that are high cost and tough to serve for throwing people at it. Those are the two areas that if you're going to be transformed, that's where I would be looking. I'm just not smart to figure out what those products are, but your listeners could know.
I mean, you have basically scenario 1 and scenario 2.
Yes.
Again,
it's not the consensus.
The probability is is it one or the other?
Right now, it's roughly 50 to 40.
Yeah.
50 being the AI is enough to dominate for a time the deficits. But that's pretty bold. What I said is that's certainly less than 20% that we're going to get the consensus view, which is the Federal Reserve and the IMF forecast. It's tough to generate. You either have deficits push up inflation and push down growth, or AI does the exact opposite. It's just tough to generate the middle narrow path.
Yeah, where do you see China right now?
China has the same. The irony is, despite the tensions between the U.S. and China, they actually have two very powerful similarities. Both are leading by far every other country from AI, and both have deficit and aging issues. And so the dynamics in China are very similar to the U.S., despite differences across all other spectrums.
If there's one thing, I mean, we've heard a lot of, maybe for your day-to-day job, we hear from a lot of Federal Reserve governors that they're just in a wait-and-see situation because they worry more about inflation than labor market.
I think it's smart. It will change if they really see cracks in the labor market. We have cooled a lot in the labor market, but if we see further evidence of weakness, we have some modest easing priced into our baseline in the second half of the year. I think you have to see another step down in the labor market. We could see that later in the summer. We've had a lot of uncertainty hit the global economy over the past 3 months.
Why haven't we seen these really bad surveys translate into the real economy yet?
Well, it's two things. One is the resilience, and the other is, again, we were still out of balance and still working it through. But again, your service-based economy, it's tough to generate a recession. I think that's sometimes lost. Manufacturing is still struggling, but 80% of the economy is service-based.
Joe, thank you so much for coming on. Joe Davies there, Vanguard's Global Chief Economist, Global Head of Investment Strategy, and author of this great book, Coming Into View. Now, don't miss the launch of our new show, Bloomberg Tech Europe. That starts this Friday. Tom McKenzie, of course, fronting that 6:30 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
In New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter. But it's bad for the product. It's not good. After that, I am never doing that again.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. We have a plan. A little bit of one anyway. The U.S. and China wrapped 2 days of trade talks with a preliminary agreement, at least to ease tensions. Musk regrets. The billionaire posts on social media that he, quote, went too far with his comments about President Trump. And we're counting down to the latest CPI data plus a 10-year Treasury auction. So let's have a look at these markets and how they're performing. Futures-wise, we are down, but fractionally. Not so much for the Russell 2000, but for the S&P and the NASDAQ 100 futures. Again, a few hours to go before the beginning of trade. There is the idea out there that perhaps more could have come from these 2 days of talks. Nevertheless, the Geneva Agreement will be put back into place, and we'll see what kind of an impact that will have on markets today. Greg Valliere just saying in the last few moments we have glimmers of hope. If we turn to bonds, we're also seeing just a little bit of a selling off, particularly in the US 10-year Treasury. The yield at 448.33. We have a major 10-year auction today. It's going to be a test of appetite, and we'll be watching it very, very closely. We had a fine 2-year auction yesterday, but with 10s and 30s coming up the rest of the week, we're going to watch those for any signals of any kind of fragility. Now let's get some stocks to watch. Let's head across to Valerie Teitel. Valerie.
Good morning, Vonnie. Let's have a check on how those Tesla shares are reacting to that latest post from Musk. We're up nearly 2.5% on Tesla. This comes after just a few hours ago, Musk posted on X that he regrets some of the comments he made about President Donald Trump in his post last week. Let's move on to defense. We have Lockheed Martin to the downside. This comes after news that the Pentagon is pulling back on spending when it comes to those F-35s, slashing the number in half that it's asking for, from 48 all the way down to 24. This is as those defense cuts from Pete Hegseth caused the defense contractors to rein in spending. We're seeing Lockheed down just less than 1% in pre-market trade. Lastly, let's end with this share in Europe. I want to talk about Inditex. This is the Zara owner. Posted slowing sales this morning, also warning that FX could hit their bottom line. That dollar weakness seems to not be helping out this major retailer here in Europe. It's the worst performing stock in the Euro Stock 600, down nearly 4%. Bonnie.
All right, Valerie, thank you so much, Valerie Teitel there. And in just a moment, we'll speak to Henry Allen of Deutsche Bank on the market resilience, and later in the hour, Mark McCormick of TD Bank on FX and US exceptionalism. Global stocks bouncing back from April lows when President Trump's tariff hikes kicked in. The VIX now at its lowest since February. Henry Allen of Deutsche Bank weighs in on the strength, writing this, quote, "There's a lot of market resilience and scope for that to continue, so I remain optimistic. Financial markets themselves are acting as an important force in determining policy outcomes. Policymakers don't want market turmoil, and when there is turmoil, then that encourages actions to avoid that." He joins us now. So, Henry, what will be the first signs of fragility for you if this doesn't continue? So, for example, we have an auction later on today. Will that be an important indicator, or are you waiting for more data?
So for me, at least, I think I'm fairly sanguine on the auction because, the 3-year auction was fine yesterday, and actually quite a bit of the fiscal news we've had at the margins has been more favourable in the last few days. Yes, it's true that we had the Moody's downgrade last month. We then had the fears over the US tax bill. But actually, the direction of travel in the Senate now looks like that various senators like Rand Paul want further spending reductions in order to pass this bill. So I think that's looking more positive. I think the big event risk on the horizon is actually now July 9th, which is the end of the 90-day extension to the reciprocal tariffs. And clearly, if those come back in, then that would have a much more negative impact on the data, just as we saw after the first Liberation Day on April 2nd.
Yeah, exactly. And we've just come out 2 days of talks with China. It doesn't look like we got anything new out of it. We perhaps will go back to the Geneva Agreement and that implementation. So just on the China side of things, does that help the market any, or is all of that priced in?
I think it's mostly priced in, and I think as Howard Lutnick and others have made very positive noises over the last 48 hours saying that talks are going really, really well, I think it's clear what the scope of an agreement might be. It seems as though by the sounds of it that there'll be kind of easing in restrictions on rare earth metal exports from China in return for the US doing something on ships. And I think, both sides do want to reach some sort of accommodation here. It's in both sides' interest that that happens. I think the way in which on May 12th we saw the US tariffs on China come all the way down from 145% to 30%, despite the fact that Trump was previously talking about 60 or 80% tariffs, is indicative of how both sides do want to reach a deal. So I think that further adds that impetus for market optimism. And of course, Trump himself is very much fashioning himself as a deal maker. I mean, I remember in his first term that he did, just before the pandemic, reach a phase 1 trade deal with China. So I definitely think that's where they want to get to.
What about the European discussions, Henry? Because we're hearing that they may go on past the deadline. They may go on past July 9th.
So I think those are really important as well. And I think what several economic blocs, including the EU, are now waking up to is that, effectively Trump and the US are fighting a war on several fronts on the trade thing because they've got negotiations with China, negotiations with the EU, negotiations with Japan, with India, with lots of countries at once. And the US are the ones who need those deals in order to kind of settle things down on the economic and market side. So I think what we might be seeing is the EU kind of effectively playing for time, realizing they've got some leverage here, because actually that was what China did. They took a pretty tough approach, were willing to retaliate, and then they got those tariffs dialed back by 115 percentage points. Similarly with the EU, they have said that they'd be willing to retaliate. They actually extended their threatened retaliation in return for the 90-day extension on the reciprocal tariffs. But they've said quite clearly, if those tariffs do come into place, they've got a bunch of stuff they can retaliate in kind. And obviously the EU, like China, being a pretty similar economic size in GDP terms, that gives them the leverage that other smaller countries wouldn't have over the United States. So I do think they want to reach a deal. The mood music is sounding very positive. But like China, they've got various tools of leverage if one isn't reached.
And Henry, I do want to bring in some headlines that we're getting now from CCTV, just out of China, releasing a statement after the talks with the United States, urging the US to resolve disputes via dialogue, saying there are no winners in a trade war, and that further playing the role of China-US trade talks will be important, that China is sincere in its talks with the United States and wants to keep communicating with the United States. So some positive signals there out of China, but also a warning that there are no winners in this trade war. So Henry, let me get back to you. Presumably this will continue. We do have Scott Bessent going to Capitol Hill today, for example. Also speculation that he might actually be in the running to be next Fed chair. Now that wouldn't happen until next year, assuming Chair Powell gets to play out his role. What do we see in terms of Fed interest rate moves this year? And does Bessent then take over?
So I think the Fed will be reluctant to move anytime soon. I think if you look on the inflation side, obviously we've got CPI later. Inflation is still lingering a little above their target, and given the tariff impact that is coming down the tracks, that's likely to stay there. So I don't think they've got much to do on the inflation side. And then on the other side of their mandate, on the labour market, payrolls are still coming in above 100,000. So I don't think there's any pressure to cut rates there. So I think they'll be cautious about moving too quickly. On the Bessent story, I mean, we'll have to see what happens. But actually, one thing I was struck by is that there are precedents for Federal Reserve chairs then becoming Treasury Secretary, actually, or vice versa. So, of course, Janet Yellen, who was Fed chair from 2014 to 18, she then became Biden's Treasury Secretary as well. So there are precedents for this. I mean, Alan Greenspan was widely, before he became Federal Reserve Chair in the late 80s, was widely speculated to be a potential Republican Treasury Secretary at some point. It never did happen, but that wouldn't necessarily be as surprising as it looks. It just hasn't happened so much in recent times.
If we were to get Bessent, or indeed a Kevin Warsh, which is another name that's been out there for quite some time, Kevin Hassett too, although perhaps not quite as much of a favourite as the other two. Do we get a lower 10-year yield just because of that fact alone? We're at around 448, 450 now. Is that fair value, and where would we go?
So I think an appointment like that would certainly reassure markets, because these are all individuals, the ones you mentioned, with Wall Street and market experience, particularly Scott Bessent in question. But I don't think one individual appointment will matter too much for the trajectory of yields, partly because, of course, the Fed does operate by committee. That even if you had a very rogue pick to be chair of the Federal Reserve who markets weren't expecting, you've at the end of the day got the entire Federal Reserve Board of Governors, all the regional bank presidents, who could in theory outvote them. And several of those positions aren't coming up until quite some time later. So I think clearly the Fed chair will set the direction of travel, but you've also got that broader FOMC committee who they matter to. So it isn't just about one individual in my view.
Henry, then are we back to sort of regular correlations? It sounds like you're pretty supportive on the equity market and you're pretty sanguine about the bond market. So is that what we see from here on out, or could there be wrinkles?
I think so, actually, because we're seeing this kind of bond equity positive correlation come back, and I think that's feeding on itself, because as bond yields have come down in recent years, that is helping to ease financial conditions, so supporting the equity market. And also, as bond yields come down, you kind of get this virtuous circle that people are less worried about the debt trajectory because yields are coming down. And in turn, as those fiscal fears ease, that can bring yields down further and help support the equity market. So I see no reason in the short term why that shouldn't continue, because, yes, it's true, the 30-year, of course, has been probing that 5% mark, but it's really struggled to go above that. And I think to some extent that's because policymakers, as we saw after Liberation Day, don't want to see a big spike in yields and will take corrective action if they need to prevent US debt becoming unsustainable. So I think, as things stand, we've got a pretty supportive backdrop. And I think the fact that the S&P 500 is less than 2% away from its all-time high, despite the fact we had a very serious US recession scare in the last couple of months, I think that's indicative of just how resilient this market is right now.
Yeah, it is pretty phenomenal. That was just a little bit more than a month ago. Henry, thank you so much for joining today. That is Henry Allen of Deutsche Bank. Much appreciated. Now, on to other top stories trending on the terminal this morning. Sources say the US and Mexico are nearing a deal that would remove President Trump's 50% tariffs on steel imports up to a certain volume. Commerce Secretary Howard Lutnick is leading the talks. President Trump is not involved in the negotiations and would need to sign off on any deal. Elon Musk has set June 22nd as a tentative launch date for Tesla's robo-taxi service. But Musk also said in a post on X that the date could shift because Tesla is being, quote, super paranoid about safety. Nintendo's Switch 2 hit a sales record. 3.5 million units of the console were sold in just 4 days. Nintendo's priority is to sustain launch momentum, but it does face challenges of catching up with demand and potential supply disruptions due to US tariffs on China. Coming up, no winners in a trade war according to China. We'll bring you the latest as Beijing and Washington wrap up trade talks in London next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
This was the first step, the framework. We had to get sort of the negativity out, and now we can go forward to try to do positive trade.
I just think we feel positive about engaging with the Chinese, understanding the real challenges.
Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
US and Chinese delegations there speaking in London after wrapping up 2 days of negotiations. Both sides agreed to an implementation plan for trade relations, now awaiting President Trump and Premier Xi's sign-off. For more, let's bring in Bloomberg's Lizzie Burden in London. So, Lizzie, what's next for the US and China after these 20 hours of talks?
20 hours indeed, Vonnie. I just want to wind back to just after midnight, that marathon session of talks yesterday.
the US Commerce Secretary Howard Lutnick and the US Trade Representative Jamieson Greer, as you heard there, emerging with this framework to implement the Geneva Agreement, this 90-day tariff truce that, as you know, we're about a third of the way through. And what they're saying is really the way through this impasse is that Beijing is agreeing to send more rare earths to the US, and in exchange, Washington is agreeing to roll back some of the export controls that it had brought in retaliation. What next? Well, what happens if there's a blow-up in relations again, as we've seen since the Geneva Agreement? And Bonnie, it's perhaps not encouraging that Greer says there aren't any more meetings in the diary. So there isn't a decoupling happening, but we're not out of the woods yet. And the other point I would make, and I think this is crucial, the export controls have really emerged as a really important front in modern trade warfare. Yes, Donald Trump may love the word tariff, and indeed a court has ruled that he can proceed with implementing his tariffs, but export controls, Beijing has proved, are a very effective way of raising a country's leverage in this trade warfare. Now, while Trump is trying to rustle up deals with the likes of Japan and India and South Korea, President Xi is doing that too. He's been on the phone with the newly elected South Korean president as well. So this could be a long road ahead. And in terms of that US-China deal, as we learned from the first Trump administration, it took 18 months to get to phase one. So, Bonnie, it looks like we're in this for the long haul.
Absolutely. And again, just to reiterate a statement just now from CCTV out of China saying it's not afraid to fight a trade war, but it doesn't want to, and urging that the two sides continue communications. When it comes to the US's negotiations with the European Union, where are we at, Lizzie?
Well, interestingly, we've had a development on that just this morning from our colleagues Alberto Nardelli and Jorge Valero. You know, Bonnie, that in the past 2 weeks, the two sides had agreed to fast-track the talks, and Maroš Šefčovič, the EU's chief negotiator, was planning to meet up in person with Lutnick and Greer. But what our colleagues have reported is actually that Brussels sees July the 9th, this reciprocal tariff deadline, as the best case scenario for when the US and the EU are going to reach a deal. And that's because there is just so much to talk about, whether that's tariffs, non-tariff barriers, steel and aluminium, or all of the many critical sectors that they need to thrash out deals on, whether that's autos or chips or pharma. I could go on. So really, just as Trump is learning when it comes to Beijing, he might not get a deal as fast as he hopes when it comes to Brussels.
All right, Lizzie Burden, thank you so much in London there for us. Much appreciated. Back in the US, we're keeping an eye on Tesla. That's as CEO Elon Musk took to his social media platform X earlier this morning to express contrition. He said he regrets some of his posts about President Donald Trump last week and that they, quote, went too far. For more, we're joined by Bloomberg Global Business Editor Joshua Gallu. So, Josh, what exactly does Elon Musk want from this? Surely contrition is just prostrating himself in front of Donald Trump. Will it actually buy him anything?
Well, it might. You know, we've seen in the past that Donald Trump is a very transactional politician and man. So, you know, this explosive breakup that they had last week, very public and personal on social media, you know, this has happened before with Donald Trump, where he has a big fallout, and then he's willing to come back to the table when people express regret or get on his side. Musk, to your point, has a great deal to lose by going into a prolonged or protracted or escalating fight with Trump because of his exposure, his company's exposure to government contracts, and the willingness or apparent willingness of Trump to go after those. So I think what we've seen is that Musk has done a bit of a, you know, he slept on it and realized that he may have overstepped and picked a fight or gone into a fight that he didn't have great chances of winning.
Now, President Trump said on the Sunday shows at the weekend that Musk faces serious consequences if he does try and indeed help Democratic candidates in any forthcoming elections. Is there something that the president could do to leverage an agency against Elon Musk? Is that one of the things Elon Musk might be afraid of?
I think so. You know, again, Musk's companies have, SpaceX in particular, has a great deal of contracts with NASA and is heavily exposed there. So, and then you look at other things like the decision to roll back. I mean, this is a congressional decision more than a solely presidential decision, but to roll back incentives for EV purchases, things like that, that are government actions that are hurting his businesses. So I think that, you know, Musk's calculation is probably that, yes, indeed, there's no doubt that the government has a massive impact on his companies, and there's little doubt that Trump would exercise his authority over those agencies to at least make his life difficult, if not even canceling some of those contracts.
All right, we'll see if the president responds later on today. Our thanks very much to Josh Gallu. Coming up, we bring you the latest on the protests in Los Angeles as demonstrators and demonstrations in part of the city get worse and the city receives a curfew. This is Bloomberg.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for our front page news, a look at what's making headlines around the world. First up on the Wall Street Journal, Los Angeles Mayor Karen Bass imposing a curfew for parts of LA from 8 p.m. to 6 a.m. She says the curfew could last several days. The LA Police Department says multiple groups continued to gather together after the curfew took effect and, quote, mass arrests are being initiated. Next up on the New York Times, hundreds of protesters demonstrating in Lower Manhattan outside ICE headquarters on Tuesday evening. They raised bright yellow signs that said, quote, ICE out of NYC in Spanish and in English. Several people were arrested. And on the Washington Post, the Trump administration preparing to begin the transfer of potentially thousands of foreigners to Guantanamo Bay. Officials shared the plans with the Post, including some documents on condition of anonymity. The Department of Homeland Security declined to comment. Coming up, a low volatility environment looking unsustainable again. That, at least, is according to Mark McCormack of TD. He joins us next, right here on Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress. I changed during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. We have a plan. The U.S. and China wrap 2 days of trade talks with a preliminary agreement, at least, to ease tensions. Musk's regrets. The billionaire posts on social media that he, quote, went too far with his comments about President Trump. And we're counting down to the latest CPI data, plus a crucial 10-year Treasury auction. So let's have a look at how those futures are faring as we await all of that data, plus that auction, of course, later on today. S&P futures, NASDAQ 100 futures, down but marginally. Remember, we are getting the results of the trade talks. Nothing major nothing hugely substantial, but maybe also nothing to weigh too much on this market. And you see it with more small cap companies. The Russell 2000 is actually rallying in terms of futures by about 0.2%. Let's look at bonds. Not a huge bid in bonds either. Waiting for that 10-year auction later today. The 2-year yesterday went pretty smoothly, but it's the 10 and 30-year that's going to test appetite, test foreign demand this week. So we will be watching those levels very, very carefully. The 10-year now just under 450. Well, let's get some stocks to watch. Let's get across to London and Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on Tesla. These shares are rising in pre-market on some decent volume, up nearly 2.5%. This comes after a recent tweet from CEO Elon Musk saying he regrets some of his posts about Donald Trump last week. So with the easing tensions between these two powerful men, it seems like Tesla shares are liking that and rallying in reprieve. Let's move over to defense. Lockheed shares are declining in pre-market trade. This comes after the Pentagon has slashed its number of F-45s it needed in half, from 48 to 24. Lockheed Martin being the biggest U.S. defense contractor, seemingly not liking that news, down 1.4% in pre-market. Lastly, let's end on quantum stocks. These are taking a leap higher in pre-market trade. Some recent comments from the NVIDIA CEO, Jensen Huang, saying that quantum computing has reached an inflection point. He's recently been quite bearish on quantum computing as a technology, saying it's around 10 to 20 years away, but he seems to be changing his tack, and we're seeing these pre-market stocks of quantum computing jumping higher in pre-market trade.
We'll see just how much they're up at the open at 9:30. Valerie, thank you so much. That's Valerie Teitel. Just under 3 hours to the latest CPI print, Mark McCormick of TD Bank saying that he's a little cautious, writing, quote, "The low volatility environment feels unsustainable again, linked to the underlying risks around data, inflation, interest rates, and tariffs." I'm pleased to say Mark joins us now. He's head of FX and EM strategy globally at TD. Mark, thank you so much for joining. It does feel like April and all of the turmoil that we saw in April is long behind us. However, those fragilities can't just have disappeared, can they?
No, I think they're just kind of hiding underneath what's a very confusing market. It's, what we're seeing is there's not as much, we're more range bound, there's more consolidation in markets, there's not really a major theme. Kind of keep languishing back and forth between, should we focus on tariffs? Should we think about what's going on with data? Should we focus on the trade war? So I think a lot of, at the end of the day, positioning is very extreme. It's very lopsided. I think there's a lot of confirmation bias that people are kind of looking for certain types of headlines to trade certain types of themes. But underneath the surface, what's really there is inflation's bubbling. We're expecting a softer data print today, but it's just we're waiting for the trade-related impact to come through in inflation, which is maybe not going to come through this month, but it's going to come through in the next couple of months. We have that. We also have essentially around the fact that the volatility around the trade uncertainty and where these things are going is also willing to be unlocked. It's just, we have a framework for a deal with U.S. and China, and that's basically all we have right now is a framework.
Yeah, Mark, in one of your recent notes, you say that in the months and quarters ahead, the U.S. is in a precarious position to fund its deficits, basically relying on the kindness of strangers. Are we waiting for that one auction that really maybe doesn't fail, but shows really less significant appetite? And could that come this week?
Well, the other common theme around what could bring back volatility is interest rates. So again, we're focused on data, and data's kind of showing, we're watching how these surprises come in. But the other thing that's been driving pretty much global bond markets is term premium. It's a function of what's happening in Japan. It's a function of what's happening in the US. I would say what's happening is the fiscal taps are broken. If we look at pretty much government spending over the next couple of years, even coming out from expectations of the IMF, is we're starting to see extremely high rising budget deficits in an era where we don't have wide, massive output gaps, which is essentially governments are spending money on redundancies, and they're doing it because the global order is breaking down. Foreign policy, economic policy, there's no longer coordination, so governments are kind of forced to do their own thing. So I think the problem for the U.S. is these deficits, primarily if you look at U.S. Treasury holdings, is driven by Japan and emerging market central banks in Asia. So is the further that the U.S. goes from Asia, the further that we kind of move away, and the more that Asia may be realigned with China, it's going to be very hard for the U.S. to fund the massive amount of supply. And the common theme we keep hearing from clients globally is when we talk to them about where they want to be invested, they want to downgrade their exposure to the U.S., whether it's equities or whether or not they want to be downgrading their exposure to U.S. Treasuries, because there's bond supply coming back in their own region. Germany's issuing fiscal stimulus. Japan's doing fiscal stimulus. The world's offering more supply of government bonds, which is going to put a premium on treasuries.
And I just wanted to mention that literally just a few minutes ago, we got a headline that Hong Kong's pension fund managers have formed a plan to sell down their treasury holdings within 3 months if the US loses its last recognized top credit rating. It's getting quite serious now, Mark. I also want to ask you about the US dollar. We've seen a huge amount of weakness recently. Does that continue? Would you fade any rallies here?
Yeah, so I think what FX is, it goes back to the first point on volatility. I think the major problem right now in trading FX is there is a extremely massive discount in the dollar. If you just run rate differentials to the US dollar, it's depending on the model you run, 3.5% to 5% undervalued. That is absolutely supported by our positioning models, which again show things that are extremely biased against the dollar. So we're kind of in this world right now where no one likes the dollar. Everyone knows that no one else likes the dollar. And, you know, as data's coming in, we're looking at essentially correlations around interest rate differentials. It's not very normal for the dollar not to care about rates at all. So the thing that worries us is the sequencing of this is where, again, we kind of think the dollar can rally a little bit over the next month, over the next 6 weeks, depending on inflation data, depending on U.S. growth, depending on data surprises themselves. So if U.S. data comes in better than expected, that helps erode some of that positioning. However, we do think that if you do see any dollar bounces, they are very good opportunities to sell. We're expecting the BDXY, the Bloomberg Dollar Index, which includes G10 EM, to fall by at least 5% through this year from these current levels. So I would say in a tactical market, you look at positioning, you look at valuations, things that are stretched. From a macro and a capital flow perspective, you should be selling the dollar throughout the year.
Another 5% from here, Mark. Thank you so much. That is Mark McCormick of TD Bank. And now 2 other top stories trending on the terminal this morning. Sources say the US and Mexico are nearing a deal that would remove President Trump's 50% tariffs on steel imports up to a certain volume. The talks are being led by Commissary Howard Lutnick, and the president would need to sign off on any deal. The people said the agreement has not yet been finalized. A human-sized Labubu doll sold at a whopping $150,000 US at an auction in Beijing. The one-of-a-kind mint green Labubu was put on auction along with 47 other Labubu collectibles. PopMart, the Beijing-based maker of the monster dolls, has seen its shares surge more than 180% this year. Nintendo Switch 2 hit a sales record. 3.5 million units of the console were sold in just 4 days. Nintendo's priorities is to sustain launch momentum, but faces challenges of catching up with demand and potential supply disruptions due to US tariffs on China. Coming up, there are no winners in a trade war. That's the latest line from China. We'll digest the talks between the US and China next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the
the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
This was the first step of the framework. We had to get sort of the negativity out, and now we can go forward to try to do positive trade.
I just think we feel positive about engaging with the Chinese, understanding the real challenges.
Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
Positive noises overnight from the US and Chinese delegations in London after both sides agreed to a plan for trade relations. The next step is sign-off from Presidents Trump and Xi. For more, let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, we did get a statement just in the last few minutes out of China saying that it's not afraid to fight a trade war, but it doesn't want to, and urging that dialogue continues. How positive is this for something more substantial than what we had already?
Well, the key here is that they have established a mechanism to keep talking. That wasn't the case a few weeks ago. They have now decided to look at the next several weeks and probably the next several months as a period to try to come to some sort of agreement on these differences that they have over everything from rare earth mineral exports to tech exports from the U.S. So this is a small step forward, but it's in the right direction if what you're looking for is the U.S. and China to coexist and trade in a way that's not damaging to the rest of the global economy.
Yeah, I mean, there's definitely lots of opinions out there. Terry Haynes of Pangea is saying this is really a cloud over any market positives. He says neither side really wants a comprehensive trade deal right now. On the other hand, you've Greg Valliere saying these are glimmers of hope. I mean, there are things that both countries want from each other, right? Can that be achieved relatively soon?
Absolutely. There are some things that they can achieve, and if they can achieve them without having those sky-high tariffs that were on a couple of months ago that was basically cutting off trade between the two countries, then all the better for a positive outcome going forward. A couple things we're going to be looking to see next is whether the two leaders who've already agreed to visit each other in their respective countries, whether those kinds of formal declarations of cooperation start to take hold, or whether we see this kind of 2 steps forward, 1 step back sort of approach that we've seen between the Geneva Agreement a month ago and the past 2 days in London. We're basically back to where we were in Geneva. It just took a month to figure out how to implement that agreement, and it seems that the U.S. is now satisfied that deal will be implemented, and some of those rare earth export permits will start to flow again.
Is there any scenario under which either of the premiers decides that this doesn't work? Or I mean, they both really have to sort of underline this now and say, yes, we can move forward from here, right?
Want to get into an escalatory situation where we hurt your economy, that's just going to backfire on us. So they tried that in April with the 145% tariffs on China's economy, and it inflicted some pain on the U.S. economy. So, and the markets reflected that, and so the Trump administration has come back from that sort of cliff scenario for the Chinese economy and the U.S. economy, and has learned a lesson that China has some leverage in this situation too with these mineral exports. So both sides now have sort of sized each other up over the past couple of months, and they see it's better for us to work together than to tear the relationship apart.
And certainly those are the noises coming out of China this morning as well. Brendan, thank you so much. That is Brendan Murray in London. Staying in Washington, Bloomberg learning that U.S. Treasury Secretary Scott Bessent is emerging as a contender to be the next Federal Reserve chair. Here's Bessent offering his view before last year's election on how a shadow Fed chair might supersede Jerome Powell before his term ends.
The new Fed chair nominee would give forward guidance beyond the current Fed chair's sell-by date. And then you would know the market could structure a forward curve since then.
For more, we're joined by Bloomberg's Adam Blenford. So, Adam, what do we know about Bessent's prospects to succeed Powell? Right now, it's sources close to the administration and telling Bloomberg that, he is a contender. But how would it work?
Good morning. Well, what we know is, obviously, thanks to